thank y'all for doing this, man. Thank y'all
Yeah.
for sticking to it and giving the people, the resources and the tools to better their lives. You know what I mean?
You're
So
the
thank
first
y'all.
guest to thank us.
Wow.
Man, thank you for that, John.
Absolutely.
Yeah.
Hey, y'all need to do better. Guests, when y'all come up here, make sure y'all pay y'all respects to who gave you the opportunity.
What's up, y'all? Get ready to break it down and level up. Welcome to Doing Numbers, the #1 financial literacy podcast in the world. Clap it up.
Yes, sir.
I'm your host, Olu.
I'm your host, Scott.
So bring your pen and pad because it's about to get real. Scott, man, what's going on?
Another day in paradise, Jack, but I'm feeling lost today.
You feeling lost?
A little bit.
Tell me a little bit about it.
I'm in a particular junction in my life where I have all of the means and the opportunity. I just don't have the guidance or the pathway.
Well, I think I got something for you today, my brother.
Mm.
Today, we got a guest in by the name of John McGhee in the house, real estate pro with 26 years of experience and stories for days. So get ready.
You got stories for days?
He got stories for days.
That's a lot of stories.
John got his start young, learning the ropes from his parents, property business, and buying rental property. And he bought his first home at the age of 21.
Wow.
Since then, he's built a portfolio across Florida and dedicated himself to helping people level up their financial game.
Okay.
Through his financial freedom program, he's guided countless families towards home ownership with tips on credit repair, money management, and property buying. Whether it's traditional rentals, Airbnbs, and new builds, John knows where the money's at. So to answer your question, man, you needed that guidance?
I do need that.
We got John on here today, y'all. Let's clap it up for John.
Thanks for coming, John.
What's up, John?
What's happening, man? Thank you for having me.
How you feeling today?
Man, I'm blessed.
Man,
Blessed to
awesome.
be here with you guys.
Awesome, man. So, John, we're going to get right into it.
Let's go.
You ready?
Yes, sir.
So tell us a little bit about yourself, John. I know I gave our people a little bio, but you could fill them in a little bit more, man, on some granular things that you've worked on and just your upbringing. I think that'll help our viewers out a lot.
Absolutely. Well, first and foremost, I'm a man of God. I'm a dad, and second generation investor. I got to see what real estate did for my family and for so many others, and I feel the responsibility to share that. You know what I mean?
Mm-hmm.
Started out in Florida. My dad used to work for HUD Housing as the program manager or director, and so while he was out fixing grandma's porch, they saw these different properties that were just kind of available. So the money that they saved up to purchase a car as a down payment, they used that money to buy a house. Rinse and repeat over the next 13 years. They still had an old Toyota, but they had this whole portfolio of real estate. So that's really how I, kind of cut my teeth. As I was growing up, they were developing this portfolio. And then they really got in the jam on one of the deals, ended up in over $1 million in debt. This is in the 80s.
Wow.
And my mom's a praying woman. She said, God, if you get me out of this, I'll share it with your people. So this program that I have is showing you how to, whatever it is for you. It could be getting out of debt. It could be saving money. It could be increasing your credit. You need all of those different tools to level up. So
Okay.
that's kind of how I got here.
And that's what we all about here at Doing Numbers, man. We here to level up,
Yes,
help our
they
people
got.
get from A to Z, man. So you the perfect person to have on today. We appreciate having you.
Well, thank you, man.
So can you tell our viewers a little bit about HUD and just, the things that they can find within that program that can assist them in investing?
Absolutely. So HUD is a governmental agency. My recollection, and probably most individuals, your grandma's porch is leaking, roof might be leaking. There's governmental dollars that are set aside to help you with that, right? Maybe there's a blighted home next to you, and you've been issuing the citations from the city to cut the grass and blah, blah, blah. Sometimes they'll come in and demo the house. Like those funds, that's part of like the program. Some of those things, they want to make your neighborhood and your experience better.
Okay. And that's housing for urban development, yes?
Correct.
Okay.
Correct.
Got you.
Yeah.
So where we at, Scott?
Man, I have a very targeted question, right? Like, most people don't know anything about hard money lending. Can you explain to our listeners what hard money lender is?
Absolutely. So the biggest, I guess, misconception is that hard money is more expensive, right? Hard money just means that it's in the secondary market. Think
Gotcha.
about Bank of America, Truist, Chase.
Right.
That would be the first tier. Those companies are looking at you as an individual. They're looking at what you make, your credit score, and then they make a decision whether to lend yes or no. At some point, no matter how much money you make, if you make $1 million a year, at some point your DTI, your debt to income, won't support any more lending there. So in the secondary market, we lend exclusively to investors. So hard money, private money, just different terms, right? We're looking at the deal, not you. So as long as the deal cash flows, we can talk about the 70% rule, or you can Google it. That's as long as the deal makes sense, you can get money to do that deal.
Okay.
It will close in your business name, not in your personal name, but that's how you can scale. So if you see these people, John Hope Bryant, he's got 700 doors. If you're going to Chase, that would never happen.
Right.
But in the secondary market, as long as the deal makes sense, we can lend all day long.
So break down the 70% rule a little bit for us, man.
Yep.
So a lot of our viewers who are new investors, wanting to get into it, but just want to know some of the terminology, because there's a lot of terminology that's thrown out there when you're in this investing game. So the 70% rule is something that I've heard before, but I would like for those that are new investors that are wanting to jumpstart, their career within entrepreneurship, what the 70% rule is.
Sure. So it's basically you want to have a 30% cushion. You want to have 30% worth of equity in your deal. So for every $1, the bank is lending you 70 cents on that dollar. It's, $1,000, $700. You can ratchet it on up. Not to say that's actually the lending perspective. That's just getting you in the mindset of a deal. Because everybody can find a deal. My catchphrase is everybody can find a deal. The biggest hurdle is funding the deal. Let me hold your hand in that process.
Gotcha.
So before you come to me, you're trying to figure out if it's a deal. We use that ratio, right? The 70% rule. So if you're in middle America, Kansas, Ohio, you can find homes under $100,000. If you're in a metro city, Chicago, Philly, Miami, that might be a little more difficult. But the numbers are the exact same, right? The 70% rule is what you're using to see if that makes sense, if it's a deal.
Okay.
So is anybody a candidate for a hard money lender?
I'm going to say yes. Short answer, yes.
Okay.
The difference in that, in my position as a lender, we're really analysts or consultants, right? So I'm going to say you, meaning whoever's listening to this, to you say that you're ready. But the time that we spend is, are you actually ready?
Gotcha.
I'm looking for clients, meaning long-term relationships, because the first deal is always the hardest. If the difference with hard money and conventional, there's multiple ways that we can do the deal, right? It can come no docs, meaning you don't have to show me your tax return. You don't have to show me bank statements. We're looking at the deal. That's one way to go, right? There's another way you can go. The property that you're purchasing, we can use market rent.
Gotcha.
So when you see a strip mall, your studio, your podcast studio could take up one unit, and then the other units that are there, that rent offsets, what you're paying out. And then another way to do it would be stated income, meaning the income that you bring in. That would be more like a cash heavy business, a restaurant, something like that. So we're looking at the amount of cash that you bring in, and we can provide funding against that. So these are just different ways to do it. When you say, can everyone do it? Respectively, yes. But there's different verticals, we're looking at different ways to make it happen.
So you're structuring a deal based off the preparedness of the person that's coming for the lending.
Yeah. So I'm doing that because yes, that's the biggest thing. And I'm here because I want to help people cross these hurdles.
Gotcha.
You only know what you know. If your mom used Colgate, you probably use Colgate. You move away, get more life, that AIM is available, Crest is available. So that's the same. Most of us, we think we're ready, but when we step out, not quite ready.
Gotcha.
So the argument discussion is maybe a little less offensive, right? But the discussion I have in the barbershop and when I meet people is, real estate is bad and blah, blah, blah. And I'm like, I'm not trying to make you buy real estate. Right. But we know for a fact, everybody got to have somewhere to live.
That's fact.
If we're in Atlanta, so if you live in Buckhead, I'm not trying to get you to move out of your high-rise apartment. I'm just saying if you have a job and you make money, you can buy some dirt, right? Your tenant can live in it and pay the mortgage. And now when you and your wife later on in life are ready to purchase your forever home, you got rental history. You know, you got mortgage history there.
Right.
You also have an asset. You could either sell it and take that cash that didn't come out of your pocket, put that down on your new home, or worst case scenario, in 30 years, let's just say you're a bachelor, you're not interested in that. In 30 years, the mortgage is paid off.
Got you.
And you got free-flowing cash. So if we wait until we are ready, in air quotes, then there's work that you have to do. I'm saying whatever stage of life you're in now, let's start now.
Got you.
And I'm hearing, are you ready a lot? So as far as being ready, like, what are you looking for someone to be ready, or what is considered a ready candidate, you know, to get into the hard money lending?
There you go.
Also, what are some red flags that you see a lot of people that need lending come to the table not knowing that they're bringing those red flags with them?
Gotcha. Great stuff. So I'm gonna come this way. So as far as the things that you need an entity, a business entity.
Gotcha.
I'm not gonna tell you whether it's an LLC, S corp, C corp. You can
discern that on your own.
Yep, you can do that on your own. But the file will close in your business name. So Jeff Bezos doesn't own all the Amazon trucks that you see or all the warehouses, right? So you got to think about it in the same light. So your entity's got to be formed. Your EIN, a business address,
Duns and Bradstreet,
all of that good stuff, right? You want to look like a business on paper when I turn that in. I don't want you to have the deal under contract, paid out earnest money, and then it's like, oh, I don't have this stuff together. So I'm saying this is stuff you can do tonight. You know what I mean? Get all that stuff done. Okay, then the pitfalls or the hurdles that you're talking about, the red flags, when at some point, pun intended, we're gonna have to get under your clothes a little bit.
Gotcha.
Right? So that's credit score. These are the 3 C's is what I like to call it. Some other mentors gave me that term, but credit is one thing. So when I ask you what your credit is, I'm not judging you.
Right.
But at some point, we're going to have to know what that number is. If we ask the number and people start looking away, we already know what that means. It's okay, though, right? So that's something that you can work on, or you can get help on. You can partner with somebody. You know, there's ways to get around it, but we just need to know what that is.
Gotcha.
So I will put credit up there first, because sometimes that takes time, right, to correct, fix, whatever it is. If it's closer to 600, your interest rate is going to be higher.
Gotcha.
If it's closer to 800, your interest rate is going to be lower. That's all that number tells us.
Gotcha.
The next C is cash, meaning your liquidity standpoint. So the difference with us, hard money versus the first tier, Bank of America, Chase, you're going to have to bring typically 20% down.
Okay.
Easy numbers. If you're buying a $100,000 home, you need to bring $20,000. If you're buying $1 million building, you need $200,000, right? That's worst case scenario. So your cash standpoint, before we talk, you should have that part figured out.
Right.
So if you got the money, we got to see that. So we run into that the whole time. You're saying, yes, I got it. Yes, I got it. Yes, I got it. So at some point, we're going to ask for bank statements that proves that, right? And then people think they don't have cash. But if we're talking and you've owned your property since 2015, I know that you have cash. You don't see it as cash, but there's cash in the walls. Right. You can do a HELOC against your primary home. You can, grandma gave you a house that's free and clear. So there's ways that we can provide cash, provide the proof of cash. You might have I know you're a crypto guy. You might have a stock portfolio. We can use that as liquidity, right? Your great grandma might have left you some bonds that we can use that as liquidity, right? So there's other ways. I'm not just saying what you have in your bank account. There's ways that we can do that.
Gotcha.
And then the third C is capacity.
Capacity. No, you're good. I mean, because you flowing right now, but I'm hearing some of the things that you can use as collateral. And I guess would life insurance be another collateral assignment that you can use?
For sure.
Okay.
Great
question.
Yes. However, let me step out here a little bit. Like a 401k, your stocks, a lot of those things, if you got $300,000 in your 401k, we would take 50% of that as cash.
Okay.
So in a moment's time, you can request it. You can get $150K. So now that $150K, you can use that as your down payment or your liquidity standpoint. So you got to, again, do that research on your own for whatever you're using. I'm saying I don't I don't know what you're bringing to the table, but that liquidity standpoint, you might feel like you got 300,000. You do, but as far as your liquidity standpoint, it's half of that, or certain things like that.
Okay, and then you were speaking about capacity, so we wanted you to dive into that a little bit more.
Yep. So your capacity is just your appetite for the deal. I like to deal with new investors, and I'm saying that intentionally. I don't mean new investors, right? Sometimes I know you have single family homes, but you want to move into the multifamily space. You're a seasoned investor, so we're talking the same language, but this is a new space. There are going to be some hurdles, some growing pains. I want to, be there with you to support you in that. I got a client that's moving from 1 daycare to purchasing a portfolio of 7 daycares. Same business, but that's a different place. You know what I mean?
Volume.
For sure.
Yeah.
So that's kind of it. Even these people that have Airbnbs. My friend Miss Cashflow, I know that's her thing, is Airbnb. But that's still a type of product. So you can take that same thing and move from Airbnb an apartment to maybe you're subdividing a house and you're using pad split, or same concept, but I'm just giving you creative ways that you can navigate through this space. It doesn't have to be buying a house, putting a family in it. There's multiple ways you can do it.
Got you. And could someone double down on a hard money loan? So let's say, I got a loan with you the first time to buy rental property. Things are going well, cash is flowing, but now I want to come back to you for another loan.
Absolutely.
Okay.
So that's the person that I'm looking for. This is my camera. I'm being a little jovial here, but I just mean after we've done all of that work, we collected all the documents, right? That's not going to change. The only thing that changes is the address and the insurance for that. Afterwards, I got a couple clients like that where your credit score is pretty much the same. Your taxes from last year, the last 3 years are the same. Your bank statement is the same. So now they just text me or email me the new property so we can scale up. That's the other part for hard money or private money. You can go as high as you want. As long as the deal works, the numbers support that deal, I got all your paperwork, it makes it a lot easier for that person that we're just speaking about. Instead of every time you go to a new bank, you're a new person. They got to vet you, see what's going on. But once we build that relationship, the sky's the limit.
Gotcha.
Okay.
So how would let's just say me. I have all of the things that you just listed: credit score, I got the capacity, and I have the funds. How do I get started with you?
So you need a property, you need a project, right? Some people go through a realtor. I would assume everybody, a lot of people know realtors, right? Great place to start. Of course, you got your own apps out there that you can do. The property is going to be the first one because we just need to verify it fits that 70% rule, right? But then what's the next thing for you? Whatever your palate appetite is it sometimes it's cash flow. What's my man? Robert Kiyosaki and those type of people. They say if you're clearing $100 a door, then you're great. That's cool if you got 300 doors, right? That might not be your strategy if you got one house,
right?
So you got to think about: are you going Section 8? Are you doing veterans, students, student housing? So we want to dig into what you're actually doing. You got this strip mall, and you want them all to be podcast studios. Great idea. We're here. But I don't know, do you need 7 podcast studios in one strip mall? You see what I'm saying? So we want to get into the deal. After you got all of that stuff, the paperwork, who you are and what you have straight, now we're digging into the deal and peeling that back. And so for a lot of people, that's where they double down. You know that you want to go into that space. They exist all over the place, all over Atlanta, all over Chicago, all over the Midwest.
Right.
So I'm saying now that I know who you are and what you want, I got a friend that happens to have those properties. I'm sending you a couple emails, couple texts, and it's it's organically just growing.
Gotcha. Okay.
And so I would need to. It sounds like I would need to have a pro forma ready for you.
That would help.
That would help. Okay.
And pro forma.
Thank you.
I'm with you.
Appreciate it.
I see where we're going here. You want to have, your scope of work, meaning the project. If you're doing a fix and flip, we need to know what that renovation is going to look like, right? I'll break that down in a sec. Your personal financial statement. That just means what your liquidity looks like on paper. You got 2 rentals in Ohio. You got a podcast studio in Atlanta. You got a trucking company in Philly. All of that stuff listed. So now we're mitigating your risk as well, meaning our risk to you as the bank. I'm sorry, let me double back real quick. When I talked about the cash standpoint and what you need to bring to the table, that 20%, I just want to address that for the good people. The reason why it's 20% down is because this is an investment property, non-owner occupied, unless it's a multi or this studio. Obviously, your office can be there, but in that standpoint, the business goes to crap. Right. COVID happens, the Great Recession. I don't know, something that we don't know about. You're gonna go home. Yeah, you're gonna stay at your house. Right now, the bank is holding the bag. So they want you to have skin in the game. Gotcha. Okay. So that 20% is typically the worst case scenario. It might be a little greater depending on how large the deal is. But if you have experience, you do fix and flips, and now you're moving into, you want to do new builds. We'll take that fix and flip experience, and instead of having to put 20% down on the new builds, it might be 15%.
Gotcha.
This is your brother, and he does new build experiences. He builds single family homes, new build. You do fix and flips, and now y'all want to build one strip mall. We'll take all that experience together, potentially, and now instead of it being 20% down, it might be like 13% down. I don't know. It's a sliding scale. So I'm just saying that experience, as you get better at your craft, we trust you more. There's less risk. So now it's less cash out of your pocket up front.
Got you. Okay.
And did that answer your question?
Yeah, it does. But a secondary question: how long does a process like that take between us structuring a deal and us making a deal and then me getting the property?
Yep, great question. So typically, we're talking a residential. I guess I should give you that as well. The way we think about it is 2 different verticals. On the short end would be a short-term product, 12 to 24 months. A new build or fix and flip fits in that box.
Gotcha.
Going the complete other side would be DSCR, debt service coverage ratio. It's just a rental purchase loan. It's just a new fancy term. But you want to buy the house next door or you want to buy this building. Same thing. That's a 30-year product.
Gotcha.
Grandma left you a house, it's free and clear. You want to pull some cash out refi. That's a 30-year loan. That both of those fit there. And then a development, you found a piece of land, you want to acquire that and build a house, a development, whatever. That may take 12 months. It could take 5 years. That fits right in the middle.
Gotcha.
So depending on, which of those areas you are, that kind of speaks to that.
Okay. Thank you for that.
Yeah. So being that we're doing numbers and we like to talk numbers, and I'm understanding that hard money it's a big part of the numbers game. And you're talking loans, 30-year loans, 20-year loans. What are some of those interest rates looking like? The points.
Yep.
And
let's go.
Some of the loan structures.
Let's go. Okay. So typically the old adage, or what I hear people say, is it's more expensive, right? Yes, but within reason. So whatever the current, if you're going out to buy a home for you and your family right now, whatever that interest rate is, add an additional point, and that's what your interest rate is going to be, typically. So if you're buying the house next door to you, you want to put a family in at Section 8. If the interest rate right now for the U.S., just Google it, interest rate US.
7%. I think we hit 7. Yeah.
So when you come to me, we submit the app, your credit is whatever it is, and we hit you with 8%, 8.25. I'm saying you shouldn't be like, oh my God, that's so high. Right. Like it's higher.
Within reason.
Within reason. Right. And then that's on a 30-year product.
Okay.
But if you're doing a fix and flip, if you're doing a new build, that's in 12 months. So how does the investor get paid? They don't have 30 years to get paid.
Right.
So that interest rate is going to be higher. It's going to be north of 10%, probably 10.99, 11 and a half.
Right.
But that's because they're only giving you the money for
this allotted time,
12 months.
Gotcha.
So they got to make the money on their money, right? That's what their job is. And I also want to give you this other one. So private money is a term that you hear. It's 3 guys, individuals. They broke their 401ks. They each pulled out $350,000. That gave them liquid about $1 million. So they're private money lenders now. You can go to them for a loan. Y'all found a house over here. You want to flip it. You buying the house for $200,000, right? You put your 20% down. You're gonna put 50,000 in it. You're all in at 250, and then you're gonna sell it on the other side for 325.
Gotcha.
Right?
Mm-hmm.
That deal works. But I'm saying you could go to them. They're not a bank, but they're private money lenders. They got a contract. If you don't fulfill your contract with them, they will foreclose on the property and take the property back.
Mm-hmm.
However, I'm just giving it to you. There's people out here that are like that. They want to get in real estate, but they don't want to build anything. You could be a private money lender. You don't have to have $350,000 cash in your pocket, but you got a 401k, you, your mom, your dad, I don't know, whatever the structure is.
Right.
I'm just giving you other creative ideas that you could be in the space as well. They don't touch a hammer, but they're still in real estate.
Mm-hmm.
Right.
So for my listeners, you don't have to play the cat and mouse game and think that it's only one way towards the path that you get into. It's more than one way to skin a cat. You can be a hard money lender. You can be an investor. There are other avenues to reach your goal.
For sure.
Thanks for that.
Absolutely.
And so I'd like to also talk about, because I hear a lot, especially in the development stage that I'm in with my real estate development group. We've talked about like loan to value. I've heard that, been thrown around a lot, and after repair value. So for those that are new investors, how does that factor into what you do?
I'm gonna answer that question, but I gotta pivot back. I only gave y'all the first number before.
Okay.
We talked about what you got to bring to the table. We talked about whether it's private money or hard money, but then the other monies that you need, right? The down payment, we've gone over that. We've hit that in the head. How I get paid.
Gotcha.
It's a percentage. Just like realtors, they make a percentage. We make a percentage. Industry standard is 3%. Okay. So if I do $1 million loan, I'm making 3% of that. So typically when you hear people say they only lend at 100,000 and greater, it's because the time and the paperwork, it doesn't make sense to some people, right? So that will be the points. You got to pay for your appraisal, depending on the size of the property, the size of the development. Could be anywhere from 500 on a home, 700 to in the thousands if you're doing a huge Walmart size warehouse, right? So you got to pay for your appraisal / inspection.
Gotcha.
And then you also got to get your insurance.
Okay.
So I'm just giving you, and then legal, my bad. Legal has to do the process and the paperwork, title search, blah, 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 all of that. I'd say $1,500 on average. So I just wanted to make sure I'm giving you all the numbers that you asked me for previously.
Okay.
But then to come back, your new question is about AVR, LTC.
LTC and LTV. Yeah.
Okay. So ARV is after repair value. You bought a property here, you did some renovation work, and then what the value is going to be on the other side is ARV, right? That's how that is calculated. I'm gonna answer, but the other side of that LTC is new construction, is what that typically lends to.
Okay.
But they're similar products.
Gotcha.
So with new construction, it was dirt. You put something there, and then there's another value on it. So I'm just showing you how they align.
Okay.
So loan to cost, typically 85%. That's what the loan is, right? And then on the ARV side, 75% is usually
where the cap is on that.
Usually.
Okay.
Right. That's kind of
or
the
that
standard.
would be a good percentage to be at.
Correct.
Got you.
Correct.
Okay.
Loan to cost and after repair value. That's what those two terms mean.
Got you. Okay. And so we want to hear a little of story, man. We want you to just, tell us about a project that you've worked on, if you're willing to share that.
Sure.
Just kind of, give our viewers some kind of color into how that process goes from start to finish.
So for me personally, how I got in the game, trying to make this quick, in college, I moved in a place. I was trying to get an apartment. They wouldn't do the lease for me and my roommate. So that meant that my parents were going to have to get the lease. So the place that we went to said it weren't for rent, they were for purchase. My parents always teach ownership. So we walk away with our heads down. And I'm like, well, y'all always talk about ownership. Why don't we do that? So I had a job. Coincidentally, the exact amount of money I had in the account was the exact amount of money for the down payment. I'm dating myself, but the property's 2-bedroom, 3-bath. I bought it for $46,000. My mortgage was about $460-something bucks.
Oh, wow.
Okay.
Take me back.
Man.
Come on, man. Come on, man. My roommate was paying $485. So those 2 years, I didn't pay the mortgage. My roommate paid the mortgage. I just paid the utilities.
Did he know?
Of course.
Okay.
Yeah. We was boys,
Okay.
you know.
He ain't shortchange you. So, you know, my man John didn't shortchange you.
However, 3 years later, I sold it for $113.
Man.
So do the math on that. At 21, my standpoint is a little bit different.
Mm-hmm.
I'm not telling you that to brag. I'm saying because everybody has that opportunity. Y'all have kids, right? Y'all are past the college years, right? Y'all have done that. But you have kids, so I'm saying your kid is going to go away to school. So quick tidbit, they're on scholarship. The scholarship pays for room and board. You make an LLC. Your kid's name, .LLC. That's the brand. The kids have other friends that they're going to be going to school with that also need room and board. Right. You don't even have to tell them. You found a place, right? You go buy the house. It's now in your kid's name, the business name. You rent the other 2 rooms. It's a 3-bedroom house to the students for whatever the price point is, right? Let's call it $850, $1,000 per room. That'll pay the mortgage.
Right.
After they're done with school, you can continue to rent it to more students, have cash flow coming in, or you could sell it and you're in the exact same spot that I was in. I'm saying when that kid turns 21, it's the same thing. If you're saying like it's too expensive, yeah, you got to figure out the down payment, but you don't have to pay the mortgage. The other side is you got a cash flowing business and you got an asset in a couple years. So that's I'm just giving you something that is applicable anywhere in the country.
Yeah.
You can figure that out.
Thanks for that.
Absolutely.
Yeah, man.
I got some other projects, but I just thought that's something that's applicable right now today.
That our listeners can definitely use.
Absolutely.
Told y'all, more than one way to skin one. Same venture, different process.
Absolutely.
Gotcha.
And is there like any type of true cost in hard money lending? And like how do you calculate, your return on investment? You being an investor yourself, if you wanted to go through, hard money lender, how do you calculate that? Man,
so I'm looking at the ROI, return on investment. You want that 30%. That's great, right? That's where you want to be. If you're building a house from the ground up, you want to have a 30% cushion. Gotcha. You bought this house for $300,000. You knocked down that house. You built the new house for $400,000. You're all in at $700,000, and then you sell it for $1.2.
Gotcha.
You know what I mean? The numbers work. You can ratchet that down, ratchet it up. That's what you're looking for. If you're buying a duplex, another quick tidbit, during the pandemic, I know it wasn't y'all, but some people stopped paying their rent. Well,
it was probably us.
Okay, well.
Nah, don't blame me. It wasn't me. I was paying on time, y'all.
The landlord still had to pay their mortgage, right? Unless they went through and got some type of relief.
Right.
Section 8 paid during that time. It's a government. So you can go to, we live in Atlanta, you can go to Atlanta Section 8 pay schedule, and this is another one. You got a 3-bedroom house, look at the pay schedule. It's kind of up there. I got it on my phone if you want me to, pull it up and show you. Yeah. But the more bedrooms, the more money, and you'd be surprised at what they pay at 4-bedroom, 5-bedroom, what those numbers look like compared to what your mortgage is.
Wow.
So I'm still giving you some creative things. People look down on Section 8.
Right.
However, that's a steady stream of income. You don't have to worry about it if they're going to be late. Is it going to hit your account?
It's guaranteed.
It's guaranteed. So that's kind of how I think about the business is where's the guaranteed money. You could do students, but you know that every semester school's over. They're going to be fighting. They're going to be partying, right? So what demographic do you relate to? You want to help battered women. You want to help single moms. Like you can have a type of product that you want to present. Yeah. But in that, you still got to look at the numbers. It's still got a cash flow.
Got you. And so could I get I know with banks, traditional loans, they have different products like a construction loan, other different types of cash loans that they are able to give out for specific parts of your project. Am I able to do the same coming to you as a hard money lender? Like, hey, I just really need a construction loan. Yep. Like, I already got the foundation. I mean, we pretty much got the plot, the parcel's there.
Absolutely.
We just need the money to construct it.
Absolutely.
Okay.
So the process works the same pretty much in the industry, whether you're going first tier or in the second tier. whether it's a fix and flip or new construction, we're funding that 100%.
Okay.
You just have to drive the project. That's not something that we created back in the day. You're doing the new build for $300,000. They put that money in your account. They drive by in 2 weeks, nothing happened. They drive by in a month, nothing happened. They drive by in 3 months, nothing happened. How do they get their money back? So now, the way that they've fixed that, right, you drive the project. So when you're doing the slab, if it costs you $10,000 for that concrete, you pay the $10,000. We send you a request a draw. It's called the draw system. An inspector comes out. They see that the concrete is there. They put the money right back in your account. $10,000. Boom, it's coming to you. Now you're doing the lumber package. The lumber package might be $20,000. You front that cost, but I'm saying you could do it on a credit card. Your mom could loan it to you. However you do that. Yeah. But then we come out, we see that the frame is up. Money's right back in your account. So typically you put the draw in on Monday, inspector comes out on Tuesday, that money is in your account Thursday.
Got you.
Real clean.
So go ahead. You got something, Scott?
Real quick, my bad. Yeah. So you were talking about your how you got started, like how you got into the game. Did mentorship play a part in that in any way?
Absolutely. Okay. So my folks, I got to see them do this. They would just talk to people about what they're doing. Right. Not bragging, just saying it could be you, right? So I've seen people scale up. A guy that was living on his mom's couch followed just this system, right? So I would say my parents were my first mentors. They went through the hard times, figured it out, and then they shared it with others. And I saw those others. He went from his mom's couch to a house to renting out rooms to students. He worked at a college, renting out rooms to students, did that for some years. Then built his forever home, right? Moved his mom there in the in-law suite, and then they used his mom's house as another rental. Gotcha. So, I mean, I got to see that. So John Hope Bryan is another, digital mentor, a friend and colleague here in the space, Kenneth Igwe, another one here at Baker Collins. So, yeah, mentors is definitely, with the internet being so vast, I think you kind of need to hone in a little bit on where you're getting information from and making sure that it's, specific to you.
Okay. And so how does one choose the right lender? Like, is that a thing?
It is.
Okay.
I think it's like anything else. Like, why do you like a brand, right? It speaks to you. So people ask me, contractor, realtor, I say the same thing. Women lie, men lie, vibes don't. So you got to have a connection with them. You and I got a vibe. So when you're bringing the project to me, I'm just not looking at you. I'm looking at the overall scope of the deal and how that works. So when you walk in a bank, they're looking at you the same way. I don't know you. You know what I'm saying? Right. If somebody came to you and said, "Give me $5," you're like, I don't know you.
Yeah.
So it's the don't be weird about it. It's the same practical thought process when you walk in the bank and they've never seen you before. They're, who are you and what you bringing to the table? Right. So I'm just giving you that to say you want a relationship. If you got a bank account right now, that's your first relationship with a financial institution. When it comes to the lender, if you're trying to scale, if you like my flair, let's talk a little bit more. Let's make sure we like each other. But again, it's still transactionally based, meaning it's deal by deal. It's not like you're signing a contract for 10 years. You know what I'm saying? If it don't work out,
welcome to death row.
Yeah.
So we definitely need to court a little bit.
Yes, I would say so.
Got you. Okay. Scott, you got something?
Yeah, I was wondering, just circling back to the requirements, what does my cash flow need to look like for a deal to be equitable for me coming to the table for a hard money lending?
Yeah, I would say depending on the type, right? We talked about a couple different types of deals. You want to have that 20%. That's just a great baseline, right? You want to have that in your close reach. I gave you the other costs when it comes to closing. I got to get paid. So points, processing, meaning the attorney, title search.
I'm sorry to stop you. Our listeners don't know what points mean.
Points. Sorry. Everybody's familiar with commission, right? That's how salespeople get paid. That's how realtors get paid. That's what most people think about in our space as realtors. So those are the points. It's a point system. So 3% are the points that I make.
So that means 3 points.
Right. 3 points.
3 points equals percentage points.
Correct.
Right.
Correct.
Gotcha. Thank you.
So Thank you for breaking that down.
Yeah.
The appraisal / inspection, and then holding costs.
Mm-hmm.
So holding costs is like insurance. If you're making a monthly payment, you're doing that new build.
Mm-hmm.
You might have a payment. Sometimes they require a reserve.
Gotcha.
You might have a 3-month reserve. You might have a 6-month reserve. So you don't have to make those payments, but you have to pay that up front.
Mm-hmm.
Okay, taxes, insurance, all of these things. These are line items.
Right.
So it's not me. This is your project.
Right.
You know what I'm saying?
Yeah.
My one line item are the points. That's how I get paid.
Gotcha.
Everything else is the deal.
Mhm.
So when we're thinking it through, yeah, you can make a lot of money, right? You see builders making a lot of money, but the holding cost, if you're going to make $1 million in 12 months, you still got to drive that project the whole time.
Mm-hmm.
You got to stay alive. You got to pay your
Right.
mortgage, eat, blah, blah, blah. So do you have the wherewithal, the strength, to mitigate through that?
Right.
So
And the expenses to carry you through.
there you go. So all of that comes into play.
So it's a matter of the deal and who you are individually in life.
Correct.
As well.
So
it's-
the market is another point. We haven't spoken about that,
Mhm.
is the market. Meaning you build the house now or you flip it now, do the renovation now, and it's available in January. A lot of people aren't looking to purchase in January
Gotcha.
because it's wintertime.
Mhm.
People are in the house. So that plays a part in it. If you got it listed in January and you thought it was going to sell, but it doesn't sell until May, you got to pay that mortgage from January to May. So I just want you to know that we're having a real conversation
Right.
instead of, well, nah, I'm pretty cool. I only got this amount. Like, yeah, but what if?
Right.
You know what I'm saying? Because
Contingency pay, yeah.
in real estate, if it can't happen, it will happen.
Mhm.
And it sounds like there's cycles to it.
For
just
sure.
As far as, jumping in it's really never a right time, but to have a more favorable time to jump in.
There you go.
There's cycles that your lender can help you out with.
Absolutely.
Now, I know we've been getting into a lot of information, man, and what I want my viewers to know that's important are some of the red flags they should look out for when they go up to a lender to be able to distinguish whether that's a predator lender or someone that's like, yeah, this is my guy.
Yep. So that's why I've said several times, 3%. Industry standard is 3%. It could be more. If it's your brother, sister, I don't know, somebody else, they could hit you in the head because they don't have to do this. Right. So that's why they're charging you more.
Okay.
When you say a loan shark, you in a real bad jam and you need somebody to bail you out.
Desperation.
Mhm.
So that's what you're paying for.
Right.
So the industry standard is 3%. So if it's north of that, 4%, 5%, that's kind of range. It's like a credit card. If you got a credit card that's 33%, it's like, woo,
Yeah.
what's going
Something
on
right,
there? You know what I mean? But that might be their only option at the time.
Right.
So I'd say that you can always look at credibility, just like before you go to a restaurant, you look at the reviews, right? So before you come to me, I can refer you 3 people, talk to them, have a conversation. What was the process like?
Right.
So again, that goes back to the vibe. But I'd say those are maybe the things that you want to look out for, on our end. What's their track record and process?
And so, I know nothing's guaranteed in this world. So there's opportunity to be denied. What are some of those common reasons that one would get denied?
Yeah, I say what we talked about in the beginning, not having that paperwork together.
Okay.
Like your entity isn't there. The P&L or the personal financial statement, like if you don't have that information, that's one thing. If you don't know that information, that's a whole nother, you know what I'm saying, thing. So your this is another one. We're at tax time. The person that does your taxes, if you have an accountant or a bookkeeper, the financial advisor that runs like your life insurance, blah, 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 and then your lender, all these people should be on the same page.
Okay.
I get people where they didn't want to pay taxes, so on paper, it shows they don't make any money.
Mm-hmm.
But then they're like, no, look, they open up a bag and it's got money. I'm like, whoa, I'm good.
You're right.
I understand that you have the money, but can you put it somewhere so that we can see, you know what I mean, where it came from?
Mm-hmm.
So that's kind of the other parts of it, is making sure that if you today you on paper you don't make any money, and then you're coming to me at the end of the year and you want to buy a $5 million building, there needs to be a story that can support that on paper, because like anybody else. Your brother come to you, he want to borrow $1,000. He don't have no job. You're like, how you gonna pay me back?
Right.
The lender has the same thought process.
Gotcha.
If you don't make money, how you gonna pay this loan back?
So it's hard for somebody who has non-qualified funds to get a loan through a lender.
Not necessarily. We just need to tell the story.
Tell the story. Okay.
So you hear the term seasoning. It needs to come from somewhere.
Okay.
So you might not have the money for the down payment, but your brother is going to give you the money.
Mm-hmm.
So your bank account last month shows 0.
Mm-hmm.
This month is showing $10,000. Where did it come from?
Gotcha.
He's going to show you the account where it went from his account to your account, $10,000. He works for, I don't know, some large company. He makes a lot of money annually. He's got stocks. So we can see where it came from. It's not like, poof, it just came out of the mattress. There's another one called anti-laundering laws. So most of the time when lenders are giving pushback about that, there's laws in place to make sure that it didn't come from a untrustworthy place.
Right.
So if we give you the money not checking it from you and somebody audits our books, we could have some issues legally.
Got you.
So the Anti-Money Laundering Act is the reason why all of those questions come about.
Yeah. USA Patriot Act.
You missed that?
I miss it, man.
The laundering days.
Yeah, bro.
The good old days.
I mean, honestly, you got cyber payments out there. That's the new way to launder,
the new way.
from what I'm seeing. So,
you need to launder your money, talk to O.
Hey, don't
he
talk
got you
to
on the
me.
process, my
Don't
man.
talk to me. I don't have nothing to do with that. But from what I've done research on, cyber payments are like the new way of laundering money because you can easily layer that without it being, without you being seen as a person. So I want to get into real quick the new day and age that we're in, man. Talking about, crypto and how that's getting ready to roll out and is playing a big role into our dollar system. How does that apply to what you do, or how are you incorporating that, knowing that, there's a new money system on the way?
Yeah, man. Just not being antiquated or old, knowing that it's going to happen. There's some things in place already. Coinbase is a USD-based crypto. So not me specifically, but lenders can receive those funds. If you're a crypto person and everything is in crypto, going through that DeFi process is kind of rigorous. But there are some platforms that are already available, just like moving from the barter system to fiat money to electronic transfers. Crypto is just coming about, and however you feel about the current administration, it's helping in that process. Having a administration that's crypto friendly, it's just merging the worlds now to make that transaction less difficult. Think about Western Union, right? To send money Western Union, you send $100, it costs you $30 to send it. Like it doesn't feel good.
Right.
If they made that fee 0, a lot more would happen. So that's what's happening in the crypto space. So now you can spend the same dollars to purchase real estate or something else.
And are you using AI in any way to help stimulate your business?
This is a great question, my friend. So my business or company, the educational piece, what we've been talking about, I administer a AI-based, so it's the same program that we've been doing all these years, right? Teaching you whether it's to save money, increase your credit, or just have a better capital stance. We have a tool that we put in place using AI, the same bad word here, budget, right? You can speak to the budget and it'll give you tools to help you increase whatever it is that you're trying to do, pay down debt, increase your credit, or save money. The AI tool will help you do that. Okay. So, yes, to answer your question, with Higher Creations, we are doing that.
That's dope, man. So I always love for all of our guests to leave our viewers with just some good books that they can go out and read, man. You are a very educated man. You've been giving us some gems today. So if you could leave just a few books for our viewers to go check out, maybe they should read to, inspire and uplift them, man. I would love to hear that.
Too.
Yeah. So how I first got started in the real estate space and the books and the platform that I was listening to was a lot of Robert Kiyosaki, That's kind of like a old school one. Cash flow quadrants. It just helps get your mindset if you want to be an investor and how you want to do it. Where do you want to do it, right? Get you in that. A great person, if you think about where he came from and then where he is today, John Hope Bryant. He's got 2 books out. But his story, he went from, a home to his mom, I think, had 7, and now he's at 700 doors. But just to see that process, right? I think those would be some, ones that I've used in my life.
Thanks for that.
Absolutely.
And so could you let our viewers know where they can find you, where they can come, maybe get some consultations in with you?
Sure.
And just share, some of the entities that you have that can benefit some people.
Absolutely. So on all platforms, at John Go Getter, JohnGetter, you can find me. Higher Creations is my financial tool. It's a course, and we have a book as well. But we also have a community. So I have some friends who are part of we use Circle as the platform. I do a weekly course right now. It's just a challenge to help you. Sometimes you're in the gym, you've paid your membership, but you need a coach. You need somebody to tell you 2 more push-ups, right? So if you join the community, there's like an accountability group where we come in every week and kind of give some tips and tools, but also to make sure that you're on track when it comes to your New Year's resolution or whatever your financial plan is. And then, of course, if you need some one-on-one, we're here to make that happen for you as well.
Okay.
Cool. What's the name of your book?
Originally it was Destroying the Root of Debt and Living a Prosperous Life. We've just kind of changed it just a little bit to lend to the lending perspective.
Gotcha.
Excuse me. So we've just added that little piece to it as well. People
Cool.
need funding. So yes, sir.
Cool.
Man, it sounds like you one of the driving forces to help our middle-class Americans, man, get ahead.
You got to do it, man. We got to be here no matter what. Everybody's nervous about the current administration. No matter who wins, they're only in office for 4 years. Your strategy has to be a 5-year plan. So you got to think about it like that. You know, these businesses that are thriving, they had a 5-year plan. So no matter who your president is or was, you're going to have to work with probably multiple people. So I don't think we can put so much emphasis there. We got to work on our plan and work the plan.
Sure.
Thank y'all for doing this, man. Thank y'all for sticking to it and giving the people, the resources and the tools to better their lives. You know what I mean?
You're the first guest to thank us.
Wow.
Man, thank you for that, John.
Absolutely.
Hey, y'all need to do better. Guests, when y'all come up here, make sure y'all pay y'all respects to who gave you the opportunity to get on this platform and to share with our audience. And from what I understand, you have a platform to kind of cultivate all of those resources and to get people's names out there. Can you speak to that just for a quick second real quick?
Absolutely. You can check us out at www.contentcatalyst.tech. We're trying to help all businesses with their online presence. The short snippet is you're great at cutting hair, you're great at baking cakes. We go to your page and it doesn't translate.
Gotcha.
So it's not that you're bad at it, that's just not what you do. So we use several different resources, AI, of course, some other automation tools to help with that process, whatever it is. I don't know what you need. You might need help with ideas for creating content. You might need places to do it. You might need some direction. You might need automation. So we have a platform. You can check us out again, contentcatalyst.tech, and we can help you with those resources.
Man, that's
Beautiful,
doing numbers
man.
for you.
That's doing numbers. Make sure you like, share, subscribe to the page. Check us out every Monday, 7 p.m. Eastern Standard Time on YouTube. And ladies and gentlemen, it's a wrap. We appreciate y'all.
See y'all next week.
Peace.
Ow!
That was a good one.
Appreciate y'all.
Thanks, man. How you feel?
I feel good, man. How y'all feel?